The first question people have, or I've gotten pretty often, is like, okay, are we in a recession? And the fact is, we don't know yet for sure until the next GDP numbers come out. I don't really know exactly when they come out, but there is this data point that the Atlanta Fed produces. It's called the Atlanta Fed GDP Now. It's a real-time estimate of what the GDP is based on economic indicators that they're absorbing as they come out. And so I think the latest big economic indicator that came out was the ISM, the Institute of Supply Management. They have like an industry expansion, manufacturing expansion, or recession kind of indicator, and that showed that we're still expanding, but much less. Like we've decreased a lot. And so now the Atlanta is estimating that the second quarter we're going to have a negative growth of 2.1%. Obviously, that will be different by the time the numbers come out, but right now that's the number, and that means that fits with the technical definition of a recession. A recession is 2 negative quarters of GDP growth.
All right, so to translate what you just said, we don't have the numbers yet. A recession in a technical sense is 2 quarters of negative GDP growth. Is that quarter over quarter, year over year? Does it matter?
I believe it's year over year, right? No, so yes, it's year over year for that quarter. So last quarter we had minus 1.6%. I mean, this quarter, the estimate is minus 2.1. It's real GDP growth, right? So it's always real. What that means is that it's taken out the inflation component, right? Because otherwise, usually.
Does that mean we had nominal GDP growth last quarter of like pretty significant, but it was negative on a real basis?
Correct. Yeah. Because if you take out inflation, you have to adjust for inflation. So inflation was pretty high. But the nominal, as a result, is high. It's just that it's less than inflation.
Am I crazy, or do we normally quote GDP growth in nominal terms, not real terms?
Always real. It's just not actively said.
People don't say it out loud. Yeah.
I'll show you the next graph though, which is the real question here. Does this matter to us? Like, if we're an investment, if we have portfolio investments, if we are investing in the markets, does this matter? And GDP recessions are lagging indicators for the S&P 500. Now, I just took an example here of like 15 years from the 1950s to the 70s, where we have a couple of recessions. Because the problem is, like, in the last couple of decades, we've had the amount of recessions have slowed down, and I think it's just because industry has better handle of the business cycles. But in the 70s, you can see.
I think there's another
clearly
player who might have some influence as well. But yes,
yes, the Federal Reserve, yes, and to be honest, the government, actually is
fiscal and monetary policy responses very, very strong.
So in the 1960s, you can see that stock market started to go down, but it was very slightly. And then you had a recession. In the early 70s, the stock market started to correct itself, like in the late 60s. And then in the 70s, you satisfied the technical term of a recession. And by the time the recession finished, you already had a rebound. And the same thing happened in the mid 70s. So the stock market peaked before and it started coming down. The question is whether the GDP is a lagging leading indicator. I just don't think it's something that we should worry too much about.
That's not to say it's totally meaningless, but in terms of investments, it's a cliche, but it's priced in is kind of the takeaway that I'm hearing you say.
Priced in, or it's just the information is not it's not fresh.
This makes complete sense to me. Markets are not just forward-looking, but extremely forward-looking and extremely sensitive to big macro inputs. This isn't to say, so the fact that this is a lagging indicator is not to say that macro doesn't matter. Macro really, really matters. In fact, it matters so much that the market is looking around the corner, trying to find any signs that, this purple line is going to be going down first, and it reacts quickly to that.
The market just cares about it in advance, maybe 6-12 months in advance. and it's what they're able to predict.
How does it know that? And should we be looking 6-12 months in advance at economic predictions?
I think so. I think what we care about is eventually what we care about is where corporate earnings are heading, right? And GDP is usually an early indicator for where corporate earnings might go, and so that there's like a feedback loop there. I guess the information for the corporate earnings, they finished, the second quarter now, but they have 45 days, 50 days, or 60 days to prepare those financial statements. At the same time, the GDP numbers are going to come out, and so it's all meshed in together. So it's hard to determine like what is truly driving the market in that sense. But it's clear to me. To me, this graph is very clear to me in showing that GDP is just a lagging indicator for the market.
Macro stuff is always fun. We end up talking about it a lot on this show because it matters a tremendous amount. Like, it doesn't really, if you're a stock picker, a public market investor, or even an asset allocator, just like boring 60-40, macro matters an incredible amount to your recent performance. I think it also matters eventually to long run performance, right? Like, if we were to go back, there's a white paper that I like called Stock Market Charts You Never Saw. I think it's by some Australian finance professor, economist or something, but he's finding periods in stock markets, the US and elsewhere, in which you can find a decade or 15 years of flat or negative returns, right? And that paradigm feels like it's gone because for the last 50 years, we haven't had that, right? It's been really hard to find places where you've been truly taking risk in kind of a broad, diversified way and not being rewarded for it. But macro really matters in that, right? If there are huge problems with growth where they can't happen on a real basis, that matters a lot for corporate earnings, which matters a lot for risk sentiment and for stock market returns.
You can even see it here. This graph is a period of 18 years. And between that period of time, you only had 71% growth in the S&P 500. This is the index rising 71%. 18 years, that's a low return on your capital if you invested in the market. And you could have had a much lower return if you exited a couple of years before when the market bottomed there. Macro does matter. This was a period where you came off, I would say, I know this period. It's a period where in the late 50s, early 60s, you had somewhat of high multiples. You had much higher multiples coming off in the period of 68, 69. It's called the Nifty 50s. It was this concept that the 50 largest conglomerates in the US couldn't do no wrong. They would just chug out earnings growth. And as a result, the multiple just increased. And then it's similar to what happened. To me, there is certain things that look very similar to the 68-70 period in the US and what just happened with COVID, right? There are certain elements of the 1940s, 1945 to 47. I think there was a recession then, which was the post-war recession. They call it the post-war recession. And that was the conversion of all the military apparatus into a civilian kind of thing. And so it had to chug along. There was massive demand. Let me see if this rings a bell. There was massive demand in the post-war recession. There wasn't enough supply. It took a lot of time to work through the supply chain issues. And that's in the young population growing. You have now like the millennials like coming into the market force. It's very similar. The one difference is at that point in time, you just didn't have like a runaway inflation, but you had it right after. So very similar to 1940s. You didn't have high multiples though. The multiples weren't like crazy. The 68 recession or 68, 69, when the market started to fall, you had high multiples. You had a little bit higher inflation. You didn't have the exorbitant inflation that you had in the 45, 47 or the 74, the oil crisis. That's where you had like massive oil inflation. So there's like elements from each recession each market correction that you can take into and combine them and create like this post-pandemic recession. Every recession is different.
Actually, answer the title question, dude. Are we gonna have a recession? Or what are you putting the odds at?
I am putting the odds at like 90%. Yes.
Okay. And the takeaway for portfolios is
it doesn't really matter by the time we are in a recession. It matters beforehand.